Markets have reacted immediately to those significantly worse than expected retail sales numbers released today, but perhaps not in the way you might have expected. Let's get some analysis with Ross Greenwood, our business editor. Ross, logic would say prices are down, but as we know, markets are anything but logical.
They're not logical at all. And in fact, they went the other way in a big way. I'm going to show you that shortly, but I want to take you through those retail numbers first because it was a surprise. Most analysts were just suggesting the retail sales for the month between November and December, remember this is, normally December you get a big pickup. And the reason you get the big pickup is because of Christmas sales, Boxing Day sales and all alike. Well, in actual fact, what you got was a decline of 3.9%. The annual sales you can see are strong. Now, do also bear in mind this was the first month in December where retail sales actually went backwards for the year. So if we move on, you have a look at the areas that were affected by this in particular. What you can see is household goods way down, clothing way down, department stores way down. Now, part of the reason for this, and there's a bit of logic in it, and that is all of those Black Friday sales in November bring forward the spending. So while it used to be the Boxing Day sales, now it's Black Friday and the Cyber Monday sales. But look at food retailing. Food retailing was up slightly, and the reason why it was up slightly is because people buy their food closer to Christmas in December. Here's what happened on the markets. Look at Woolworths, up by 2.75%. You wouldn't have expected that. Coles up by 2.25%. Metcash, the IGA owner, up by 1.3%. They were strong. It was mixed in other areas though, and I'll show you a few of those stocks as well. There's Myer. So department store sales were well down, and even though Myer has staged a big recovery in recent times, its shares down by 2.25% or so today. Harvey Norman down by about 2/3%. But see, JB Hi-Fi in a similar area to Harvey Norman, up by around 1/3%. So that shows the fickleness of markets. But part of the reason for this is largely an expectation that maybe those soft retail sales might just give the Reserve Bank some cause to pause for thought when it meets on Tuesday next week.
So, Ross, what's your read on this? Does it change the thinking of the RBA when it meets in a week's time?
I think it sort of adds, if you like, to some of the narrative that the inflation rate is close to peaking if it hasn't already. And those retail sales, softer in December, do give some suggestion. Even the Australian Bureau of Statistics was saying today that they believe a lot of people with higher prices were bringing forward their spending to where they could get bigger discounts in those Black Friday sales. So if that's the case, once you see the January sales out and whether they have also slumped, that gives you a bit of an indication that maybe inflation has peaked and therefore the Reserve Bank also might just start to taper off these continuous rate rises. But given that inflation was so high and was surprisingly high last month, you also know that they want to get rid of that inflation. So the markets right now are suggesting there's almost no chance that the Reserve Bank will not raise rates by 0.25%, but it's what it does afterwards that maybe now is the bigger guessing game.
And Ross, it comes at a time when this review in the RBA continues, and as Andrew Clennell and I discussed earlier, in that mix is the possibility that the target range of 2 to 3% inflation is also maybe amended.
Well, it could be. And the reality is that, you know, for years and years, the Reserve Bank didn't basically take any action to bring its inflation rate back into the band, the preferred band, when it was well below 2%. And then all of a sudden, of course, COVID hit, and then inflation started to rise, and it's having to now react, raising interest rates to try and get inflation back into that 2 to 3% band. What the band is set to be determined by this review and certainly by the discussions with the Treasurer afterwards. But then the second part about this is the notion of full employment. The reason why Australians are able to spend right now is because we have such a low unemployment rate. And the fact is that this is good for Australia, this is good for the economy, this is good for every Australian, but we can't at least deny the fact that by being able to spend, Australians right now are adding to that inflation, which is also adding to the pressure for interest rates to keep on rising. So this is, if you like, the double-edged sword of the full employment. You want more people in work. You want them to be able to afford the rising prices. But the rising prices also add to the interest rate story as well.